Welcome to the Women's Business Center at Cornerstone Alliance's Business Plan Certified, proudly sponsored by Stearns Bank. During this series, you'll gain tools to help you launch or grow your small business. Now, let's begin.
Hi, everyone. Just want to introduce myself before we get into this. I understand that accounting can be kind of a niche topic, and if you're not familiar with it, it can be intimidating. It is something that I'm hoping to relieve some of that anxiety around it today. In your handouts, the first 3 pages is kind of like a dictionary of financial terms. They're broken out into 3 categories. One being like overall business explaining, how your business is doing. The second one being around revenue. A third one around expenses. And then around financial planning, which is what we're going to be talking about today. Mostly today, I want to go through and give information, and then we'll talk about how the examples in Live Plan, how we would actually break those ones down. Just to start out, I wanted to go over some responsible banking practices. Typically, when you're doing your businesses, it's best to establish a separate bank account. One of the reasons for that is just for transparency. I've worked for companies where people are coming into their taxes at year end, and they have on the GL like expenses for your dog. And it's like, oh, I'm just going to take that out. I wasn't supposed to put that on this card. And those are just kind of very avoidable things that we can do to be organized. So what we want to do is, if we have established a separate bank account, you reconcile that bank account each month. You don't need to. QuickBooks is a great, cheap tool to do it, but you can do it in Excel. You can do it in Google Sheets. Google Sheets is free. To pay for a Microsoft subscription. So actually, a lot of my clients are using the Google platforms and the tools for it. In that factor, a lot of businesses here, if you set up a bank account and you need to get funding in the future, you can look at that business and use that bank as a reference. So it's very important to just have that transparency between what are your account and what is your business accounts. So there's pretty much a set of financial statements that every business will look for. It's giving you a comprehensive view of your financial health and performance over time. So there is a profit and loss statement, a balance sheet, a statement of cash flows, and I want to throw your budget in there as the 4th item because we are talking about our financial plan, and that's essentially your budget. What's important about it is you can look for it later on and identify trends. So when you're forecasting out, you'll look back at your historical numbers to plan for the future. A lot of times when we're doing it, I caution people from being overly optimistic. I'm very conservative in most of my numbers just to say, okay, how can we get here? And if we're doing better, we revise it. It's always a live document. This document is not something you're going to sit and forget. I meet with my clients every month to go over financials so that we can say, where are we different? Are there things we need to change? So it's a very fluid document. I'm going to put this one down. Hold on a second. In here, they'll also, for funding applications, they'll ask you for these documents. So it'll be something that you want to be able to speak well to before you would go into any investor meeting, if you have one set up. So if you've already established your business, when you come in, you'll want to be able to show the last 12 months if you have it. And there are different layers to these documents, and you can make them as detailed as you need to be. As detailed for your audience. So you yourself might have one where you're listing out every pencil you're buying, every piece of paper, every printing, but you might just want to put that all together in advertising if you're showing an investor, because they don't need to know exactly what your plan is for advertising. You want to know what you're spending on it, and they want to know that you're moving forward with advertising, but you just want to tailor these documents to your audience.
So you were talking about if you already have a business established, but if you don't, then you won't have a lot of these right here. So what do you do then?
You start with your budget. So that's your Yeah, so hypothetically, what you're doing is your budget will be set up in the same form as like a profit and loss statement. So the three main pieces of your profit and loss statement is your revenue, and then your expenses, and then what your profit will be at the end. And we will break down how those look. And there's a key measure in the middle, your cost of goods sold and your gross margin. And we will define those aspects so that we're able to say this is what we would do when we are starting new versus if you're already established. All right, so this is that profit and loss statement. So we're kind of going right in order, so thank you. So it starts out with your revenue recognition. It's all your income from sales, services, or other methods you're getting money into it. Also, you're subtracting out your cost of goods sold. So your cost of goods sold is what you are actually selling. So for example, if you're selling t-shirts, the cost of goods sold is just the cost of your t-shirt. So it's not the cost of everything else to do it. So if you are doing this and you're selling your t-shirt for $12 and then the price goes up from your supplier and the t-shirt's $15, you're already at a loss. So there's no way you'll be able to sustain your business in that fashion. So I always check this calculation to make sure it's positive before we move forward. And then after that, you would subtract all other expenses, which are those rent, first startup costs, things that don't directly go into your product.
So what if you're providing a service?
So if you're providing a service, are you planning on paying yourself? Yes. So you'll say, okay, how do you figure out what you're charging? What are you going to charge someone for your time? You could work backwards from what you want to pay yourself to determine your pricing model when you're selling something out. Because a service, like a lot of times, especially in the environment we're in right now, you might be able to avoid some costs or you only had ad hoc costs. So traditionally, your rent would always have been a fixed cost. You always need a business storefront. You're always thinking of it that way. I think one of the great things that came out of COVID is we've gotten some more flexibility with the way we can structure businesses. So you might be able to you could work from your house. And then you could run a meeting space. You can ask a partner if you can use their meeting space. You can meet at an area. I don't know if it's still open. I think there was a place in town where you could rent conference rooms and have areas of that way. So you can look at ways you can lower your fixed costs to be directly related to your income as you sell things out. Think about how much time you're putting into it. I would never recommend be like, okay, I'm going to come in and you need to build your reputation. So when you're building out, you can say, I'm going to start out and have a lower cost for my time and get word of mouth, get a strong group of supporters. And then you can be like, well, I'm going to go up 5% next year. So your business plan we're building, it's year one. A lot of times they'll like to see 3 years. So you can say, okay, how are we going to move this forward? Because costs continually go up. So if you're trying to maintain your lifestyle, maintain things, you have to sometimes increase your prices. And it's like, as long as you have a plan around how you're going to do that, it makes sense. Also, some of the times you can be pretty transparent. Be like, this is I'm going to give you a first time customer discount or something along the line. There are different ways to get people in your door, and you can build those pricing models into your budget. The next piece is your balance sheet. Your balance sheet basically is a snapshot of your financial health of the organization. So it shows your assets, which is everything your business owns. Your biggest asset will probably be your cash. But if you also buying any equipment, any property, anything that your accounts receivable, inventory, that's all on your assets section. Your liabilities is anything your business owes. So if you have a loan, it's in your liabilities. If you have accounts payable where you owe people money that you haven't paid yet, it's in there as well. And then after that is your equity section. That's how much your business is actually worth. So if there was a math equation for this, which, I'm an accountant, so I'm going to say this, it's like your assets always equal your liabilities plus your equity. Don't make that face. I sell it. I didn't put that up on I didn't put that on here on purpose, but that's the way the structure of the statement works. So you'll say, so if your assets are more than your owner's equity and liabilities added together, there's a formula problem. So it's like, okay, we need to go back and figure out why that is. Am I misstating something? Do I have a formula pointing the wrong way? But that's your number. That's an easy check. So if you bring a financial statement in that doesn't balance, it'll immediately be a red flag to a potential investor. The way that your owner's equity works into your net income, there's two aspects to your owner's equity. One is your net income for the current year plus your net income from the prior year. So the prior year is your retained earnings. So like if we're coming in, we have $100 from last year that we made. This year we think we've made $2 this month. Our net new retained earnings is 102. But that number will balance and tie to the other profit and loss statement. All right, so statement of cash flows. This one, I think, for me, is sometimes the one that gets forgotten about the most. It's making sure you actually have the dollars to do what you need to do. You can be profitable on paper, but sometimes when you do it, you need to have cash up front to be able to pay for things that you're going to benefit from later. So when you're looking at your statement of cash flows, you want to make sure that you are planning properly to pay for the things that are coming up. So you might need to get a loan earlier. It might be a short-term loan, but you need to look to say, do I have the money to, if you're doing the food truck example, do I have the money up front to buy the food truck to start? So you have to think about the way your cash actually flows through your business. And this could also, once you get it rolling a little bit more, it could also drive the way that you're setting your terms on your business with your customers. So there'll be sometimes, like I have a dog walker who I'm paying half up front and half later for the month. And she's working that into her plan to know that she can pay for other things. Also, you also think about this in terms of when you're paying your bills. If you have money and if your investor is giving you time, if your vendor is giving you time to pay, you don't have to pay that immediately. If they're saying it's due in 30 days, you can hold on to that to the 30 days depending on when you're expecting to get money from your customers. I know that in my life, my mom plays off her credit card every 2 days. So I'm like, why are you doing that? You don't need to do that. She'll just go back in and she'll pay every time because she doesn't like to have the money on there. I'm like, yeah, but that money, you don't need to do that. It's a little bit too stressful. You can use that money to earn some interest depending on the balance of it. There's a lot of things you can do with that. A lot of the bill pay softwares, which you probably don't need at this point, they will kind of default to paying it close to that due date. And your vendors are setting those due dates, so you don't need to necessarily worry because they know net 30, they say net 30 and you pay them in 28 days. They shouldn't be coming back to you saying, why didn't you pay this sooner? So I think it's just a way to be thinking about when you're getting money in versus when you're spending money out. All right, this is one that I actually can't stand because it looks like a bunch of letters. It's yeah, EBITDA is what I always call it. I don't even know how the other people say it. It's earnings before income taxes and depreciation. So it's one of the things that you're in amortization, and you would have amortization on a loan, or you would have depreciation on a fixed asset. Basically, what you're doing is you're working back from your profit and loss statement. And you're adding back any interest you've paid, any taxes, any depreciation, any amortization to get a very good look at your operational dollars of your business. Investors will typically ask you for this because it's taking out the stuff that you have, I would say, less control over. So it's looking very solidly at your business and the way it goes forward. All right. So this is where I think we're going to get into the more financial plan, which is your budget. Every time you make your budget, you want to make sure that it's going back to your strategic plan. I always stress this point that your budget you want to make sure that your budget supports your business. You shouldn't there are limitations to what you're able to do in your budget, but you have to go back to whatever your core goal was and what your plan was for your business. Make the money, make sure this is consistent with everything that you've planned for in your business. If you have a business and that you are doing something that's seasonal, make sure that your plan reflects a higher revenue in the summer. If you have a lawn cutting business or if you're doing something based on tourists. So it's sometimes people think it's a shortcut to take your total and spread it over the 12 months, but it'll come back to kind of bite you in the butt. So I think it's definitely it's worthwhile to make sure you look at your monthly in and out to have a realistic look at what your businesses will do moving forward. Yeah. So next we'll go over the pieces of your budget. So there will be more slides after this, but essentially your budget has 4 different categories to it. One being your revenue projections. So that's your estimated income from your sales and service. So if you're selling a good, it's the unit price times the units sold. For services, it's your hourly rate times the hours worked. And that's just kind of stresses, make sure you're using reasonable estimates. Your variable cost. So cost of goods sold that we talked about earlier is if you're doing selling a good, that's the number one biggest variable cost because it fluctuates with your business activity. If you are hiring a person, you are paying based on commissions. That's in one way that you can also have a good idea of how you would be able to build your personnel. So if you are hiring someone for a lower fixed cost, let's say you agree to $1,000 every 2 weeks, but you said at every sale you make, you'll get a portion of that. So that person's salary would be split in 2 of these categories. So no matter what, she's going to get that $1,000 in fixed costs. And then depending on what sales she brings in, there'll be a piece of it that's variable. What Brandy was speaking about earlier was one-time expenses. These are large and frequent costs that you need to take into account, whether it's for equipment, startup. You might I think we have a lot of resources here, but maybe you're doing something that has a large compliant piece to it. And you're like, okay, I need to work with someone who helps make sure I have everything structured to support, we'll say, we can use the marijuana industry because it's around us right now. So that's an industry that's, highly regulated. I want to know how to start. So I know that for a startup cost, I would need to work with someone to make sure that we get that done. But once those are in place, unless they change too much, it'll be a startup cost to think about those. And those need to be included in your budget. So here is the two different business types for projecting your income. I did mention it briefly on the other slide. For goods-based, it's the unit price times the number of units sold. For service-based, it's the hourly rate times the number of hours worked. Make sure when you're taking the number of hours worked, you think of these other times. So you might be with your client for an hour, but you know that you'll be working for 2 hours to prep for that. So always account and be transparent with your customers about your time. Be like, this is the direct time with you, and you can even break it down on your invoice. This is our meeting on 6/10 for an hour. This is what I did in advance for that. It took me an hour. So make sure when you are building your invoices out and talking with your customers, you start to think about some of those a little bit less obvious touch points when you are providing value. Everyone here has a value to add, so don't underestimate yourself on that. Make sure you include those in your time. Okay. All right. So fixed costs. These are items that are going to occur regardless of if you make any sales or not. So we talked about rent already. That's probably the go-to one that I feel like everyone goes to. We talked a bit about personnel. There's also at times insurance premiums, software subscriptions, also professional membership and depreciation of assets. Those will all occur. I think one on here that is kind of in the bottom that you don't see that I always think about is loan payments. So make sure that when you are working with a funder, you sometimes have the option to structure your loan a certain way. If you don't have that option, you just make sure that you are reasonable when you enter into an agreement so you don't screw up your business reputation and your business credit. So you want to be working with the bank to come up with a term that you can hit. A lot of banks kind of pride themselves on being very small business friendly. So you can ask them if they can work through this loan. Ask them if you have the option to pay down or to change the terms, or can we revisit the terms of this in 6 months when you have, let's say you paid 6 months on time, you can do it. And you're like, okay, I've built my business credibility. Can we have a already structured set point so we can revisit the terms of this agreement? I think as you build your reputation, they'll be able to work with you through those. All right. So these are some variable costs that we went over as well. Utilities is one that if you have a space, they do fluctuate with your activities. I know when I used to work for consumers, we were able to set businesses up on a plan that was like a budget plan. So they took the amount throughout the year, and they actually said instead of having it be based on your usage, you can pay $100 a month and it'll cover the whole year. So I know if you have air conditioning, your price sometimes skyrockets in summer and will drop in the winter. So they will work with you on these things. So it's just being able to ask and saying, do you do this? Do you not do this? If they don't do it, okay. But if they do it, it's something that you can work into your plan so that you can have a better idea on your forecast. And I also mentioned the sales incentive. It's something that I think is sometimes underutilized. If you're joining someone, you want to motivate people. Money is a kind of a good way to do that. But you having some type of hybrid between we acknowledge what you're doing, we're going to appreciate what you do, But if you perform, let's acknowledge that as well. It's a good way to build a partnership with your team and a good way to always keep a good idea on your sales. Here's some startup costs for some strategic investments. There's the legal fees we talked about, licensing, looking at market research. That's some startup costs you think of. If you have a special equipment, like I know like some of the food trucks have like specialized ovens and things along that line, those will be one-time costs that you won't be able to do your business without. Also, you might want to look at say we're doing great in 2 years. What are the costs to grow? From a website development is on here. There are a lot of lower cost options that you can do. I think I've used Squarespace. Yeah. I've used Squarespace, and I think Wix is the other one I've used. They're pretty user friendly. I think you guys have already done marketing classes, but something that if you're able to do some of those costs yourself, but there are like add-ons to a lot of websites that you could make them even bigger if that's the way you're going to reach your audience and how you're going to grow. All right. So I have a lot of pages of notes, but I'm actually through quite a bit of it. So I appreciate you guys sticking with me. All right. So break-even analysis. This is something I think you would want to know. At what point do you break even on your sales? Like how much do you need to bring in to cover all of your costs? So it's basically what you're trying to do is find out what at zero. Like at this point I'm losing money. At this point I'm making money. So you have a realistic goal to say I at least want to try to make money. So there's two key formulas for it. In units, it's if you take the break even, so you first figure out your break even units, which is your sales price per unit minus your variable costs per unit. And then you take that units times your selling price to get your break even revenue point. I think it's in our document, but I can give you guys these formulas. So I feel like and we can even walk through one of these. But yeah, these are my notes. But
there's only one packet for you guys.
Yeah, these are 2 different packets, but I'll get with Chrissy. I think she'll send this out afterwards too, but I'll actually add a separate section on break-even analysis. I should have expanded that out a little bit more. I apologize for that. All right. So talking about paying ourselves and contractors. So when you have employees, there are tools out there and a lot of third-party vendors you can use to run your payroll to help with compliance. Gusto is, I think, pretty cheap. It's a cheaper option that we really like. What they'll do is they'll actually help you out with filing your quarterly reports. A lot of accounting firms will use this tool. It's not exclusive to accounting firms, but it's the one that I've seen in, I think, 3 different companies that I've worked with have used Gusto. So as a consumer, you can use this to help with the compliance piece if you're there. Or if you're running your own business, you can pay yourself via equity transfers. So you're like, at the end, you're like, I have made $20,000. I want to keep 15 of that in the business. I want to pay myself $5,000 and pull it out of the company. One of the things that I think is important is if you are hiring a contractor and you pay them more than $600 for the year, you're required to give them a 1099. So you'll, as an employee, you get W-2s. As a contractor, you get 1099s. And they're due in January. So you'll have to keep track of your contractors for that compliance piece. Yeah. All right. So as you are doing this, there are a few different areas I would say that are critical to manage your financing. One would be tracking your inventory. If you're selling something, does it make sense for you to buy something in bulk, make it in bulk, versus ad hocly when you need it? So you need to take a look at your storage costs, if it has a certain shelf life, if there are many factors that contribute to how you handle your inventory, especially if you're doing something very customizable. So if you are, maybe you can buy a bunch of a base product and keep it, but you need to be tracking that on your assets on your balance sheet. And then as you sell it, it becomes an expense and it's part of your cost of goods sold. So if you're buying it up front and you're holding on to it and you haven't sold it yet, it's part of your inventory on your balance sheet versus part of your profit and loss statement. I did talk a little bit about accurate bookkeeping, QuickBook, Google Sheets, a spreadsheet, a piece of paper. I would recommend putting it somewhere that, it lives on. So like I would put it in a computer versus writing it down. But I do think people can overcomplicate some of these. If it's a spreadsheet and you're writing down everything that you're spending, a lot of times where I would start would be looking at my bank statement. Look at it every month. Is there anything on your bank statement that's not on your books? That's why we reconcile cash every month. Before I would take on any client, I always go and look to see when they last reconciled the bank statements. It's a very good indicator to see how financially savvy a business is, because they'll be like, okay, you haven't reconciled your bank account in 2 months. Why are you behind? Is there unknown items in here? Are you accurately reflecting this in your financials? But that's something that's a third-party generated document that'll help you check if you're doing your financials correctly or not. There's tax compliance. If you are an LLC, a partnership, sole proprietor, you're doing a separate form on your taxes to reflect that. With businesses in Michigan, you have to work with Laura to get your business registered. Yeah. I was like, didn't think of the right word. All right. So I know that with this, you guys being in this course, you guys are already taking a lot of the steps to be able to talk about growth and fundraising. There's traditional ways of doing it. You can go after loans. You could also, if you have money set aside, you're like, I've been saving up. I'm running this on my own. I'm going to get us there and then pay myself back later on. You can also look for grants and ventures. People, I have seen, crowdsourcing, things along those ways to get money. I think probably the most, every business is different, but if you're going an investor route, it's a way that you can kind of build your business credibility. You can work with the partners we have in the community and that Cornerstone's helping you align with. All right. So in LivePlan, you'll be able to build your budget. You can develop 3-year projections. You can identify your funding source, and you can start implementing systems to keep yourself transparent and aware of your financial health of your organization. So there's 4 different categories in the financial plan. It's your key assumptions, your use of funds, where you're explaining what you're spending, your funding sources, and your forecast components.
Could you go more in depth on the gap?
Yes.
Can you say a little more about
Sure. So a lot of times people will ask you what your core costs of your businesses are. So that's everything that you can control. So it's your earnings before depreciation, interest, taxes, and amortization. So you'll take your income statement. A lot of times you'll see them structured where they'll actually have like an other revenue and other expense lines at the bottom. So you'll do everything that's core. It'll be like revenue, cost of goods sold, all your fixed costs. Then you'd have your net income here. Your net income is not your EBITDA. So then you can see down here where they'll list these items that you'll be adding back, because your depreciation will be up here. You'll add it back. You'll say, okay, this is something that has no effect on cash, but something that we have to put in our books. Interest is something that doesn't really affect your core business, but the business as a bank doesn't want to know if you're continuing, doesn't want to know what you're paying them. They already know that. So they'll ask you to add it back. So it's kind of working into a different financial formula calculation that you will be asked for at a business meeting at times. Just, if you don't really need to know this, but depreciation schedules, like, be reasonable with some of your items. I think like a few years ago, you could say, oh, I'm going to buy a computer. It's going to last me 5 years. You're probably not going to have this computer for 5 years now. So think about what that looks like. If you think your equipment will last you, like I think for like ovens and things along the line, you probably can reasonably say for 5 years. But for computers, a lot of times it's now 2, and you'll say, is it even worth, like, what's your threshold for depreciating that or just expensing it up front? If you're using it for more than a year and it's more than $5,000, I would make it a depreciable asset. But if you're not using it for more than a year, if it's less than $5,000, I typically will expense it at that point. Yeah. One of the things I would say, just to follow up, whatever you write off for your taxes, just make sure you write down your assumptions. Right. You think you're going to remember all of this? Yeah, you might not. I'm getting paid. I'm like, what did I do? And I'm so thankful that I have somewhere where I wrote it down once. I'm always like documented. I've always been working for an organization who has gotten government grants, so I've been audited all the time. So even though it's less likely that you will be audited, doesn't mean you shouldn't have the same practices of documenting and writing down so that you remember what you do. And I'm around. I'm in the community.
Thanks for joining us. We'll see you next time for more strategies to empower your business success.